Hey everyone, today we're just going to be doing a market analysis video looking ahead for the events of the week and looking at some volatilities for the broader market, seeing what's looking cheap, what's looking expensive. Is it a good time to enter positions with high betas, things of that nature. And we're also going to be introducing something that I personally look at a good bit, which is the lumber to gold ratio. It's not perfect, but there's a little data behind it, so we are going to take a look at that as well. So without further ado, let's get started. First, let's just go over the events of the week, guys. We have a big week coming up. I can't stress this enough. Today we got consumer inflation expectations. They came in much higher than expected. Forecast was only 4%. We were actually forecasting a 0.2% decline. And instead what we got was we got an increase of 50 basis points compared to previous, beating by 70 basis points. Huge difference in the discrepancies there for consumer inflation expectations. We also have that leading into a massive week. So tomorrow there isn't a whole lot going on. We just have the red book year over year. It's an okay indicator just for health and stability, but really nothing crazy. Couple of Fed speakers, but man, oh man, Wednesday's gonna be a fun one. We have the NBA purchase index. We have mortgage applications coming in, and then at 8:30, you guys already know we got the CPI coming in, core CPI coming in. And then at 10:30, we have inventory data for hydrocarbons, distillates, crude, um, Cushing, Oklahoma, everything coming in. It's going to be a massive day on Wednesday. We also have the FOMC minutes dropping at 2 in the afternoon. Huge day Wednesday. Now for Thursday, we have PPI, initial jobless claims, a couple core numbers coming in, continuing jobless claims as well. Pretty big day. And then finally on Friday, we're capping it off with the start of a couple of earnings names starting to trickle in here. We got retail sales coming in, export prices, import prices, industrial production, and the Michigan consumer sentiment for economic conditions. A lot of stuff coming in. So you would think that with all of this, especially with the increase in consumer expectations for inflation, that, the market would be pricing this volatility. Absolutely not. Market is doing nothing. The market is effectively at the lowest levels of implied volatility for the next 30 days in the past year. Lower than any point during the rally we saw in August, pretty much any point that we saw in February during that, kind of melt up ish scenario. It is mind boggling, right? If we look at the IV 30 percentile, we'll see it right here. Sorry, just a little lag there. Right there. This is the S&P 500. We're at 1. Right? Cheapest it has been in nominal terms. Interesting, however, how the skew is an 83rd percentile, so the top 17%. I think that is worthy of noting. It seems like smart money might be, kind of bidding up skew here on the S&P 500, trying to get some hedges in place. As we can see right here, we saw the market really, you know, get rid of the skew levels as a lot of calls ran or a lot of puts ran into the money. Maybe some options trades went off. We're now starting to see this build back up again. Pretty interesting indicator as well. So with that being said, the balls look relatively cheap, and this is when I really want to introduce the lumber gold ratio. First, what is the lumber gold ratio? Well, the lumber gold ratio, or the gold lumber ratio in the case of this article, basically discusses how it is an indicator of the VIX, so to speak. And there is some really good analysis. I'll add the link in the email here. But really, there is a pretty solid correlation. It's nothing crazy, R squared of 0.13. It's not, like I said, it's nothing wild, but it is pretty interesting. It is essentially the level of expensiveness for the economy, right? Lumber is a very economically sensitive good. You need lumber to build infrastructure, homes, and things of that nature. Gold is the traditional run for the bunker risk off asset, right? So when the ratio of lumber relative to gold is going up, it kind of means, hey, economic conditions are improving. And when it's going down, it's like everybody run for the bunker, everyone try to get out. We need to survive. I would like to note that we saw the lumber gold ratio really begin to bottom out here in October. And conversely, look what happened in falls on the S&P 500. During this time period, we did see much higher levels of volatility. If we go back and we look at what happened here, coming out of February, right? So this turn from January into February, we saw the ratio accelerate. And what we saw from January to February, we saw vols just considered to trickle down. We've seen vols stay low, but the lumber gold ratio has crashed, right? Now, this could be, due to a multitude of things, and a lot of people can say, oh, well, inflation, the Fed's cutting. If we go back to the lumber gold ratio, historically, it's very interesting how this has happened in multiple cycles in the past. The VIX versus the long run relationship between gold and lumber, you can see this, right? The inverse of lumber gold is gold to lumber. Very interesting stuff. Just something that I look at. Obviously, I don't live by the lumber to gold ratio, but I do take a look at the lumber gold ratio, and I do like to see what is going on there. If you guys have any questions regarding that, feel free to message me. Besides that, guys, it's just gonna be a big week. Volatility levels look really low considering what we have coming up. So I would just like to make a note of that as we continue to see what is going on there. So guys, that is all I have for this one. If you guys have any questions, feel free to reach out, and I will see you guys in the next one. Take care.